Tahir Bacha is Chief Investment Officer at Invesco Mutual Fund. Tahir, good to have you with us here. Thanks for your time. You know, I remember, and I was sort of saying this on Friday, we had Naren with us from ICICI Pru, who was, he was on a week and a half back. It was right out of the budget. And he was saying that, there's got to be, in a normal market, there's got to be more up and down, more volatility really. And I think, of course, lamenting about the fact that money is coming in and you've got to deploy, but markets are what they are. So it's kind of tough. How do you see this reaction and what we're seeing globally? Markets will do their own thing, but I want your thoughts on this, on what's going on in the US. What's your team and what's the global view, Tahir? Are we likely to see a US profits recession? Go on.
So Prashant, we've seen a plethora of events shape up over the last few days, and it's obviously difficult to make sense of everything and put the pieces together. There will be, there are different factors which have been affecting different regions, whether you take Japan or US or maybe even emerging markets for that matter. I think as far as the US is concerned, what we read and what we probably still share as a view and probably is a continuation of what we, in a way, expecting that, we will probably try and see some correction as far as the inflation dynamics out there are concerned, and some bit of slowing of growth as well. It is still not very clear at this stage as to how much is a slowdown out there. We've seen the initial reports only from a job perspective, and we have to still probably await data at a ground level, and that probably will come about in the next some time. But in the meanwhile, I think what is happening is quite unexpected lines in a way, I would say that, because there was this expectation that in the second half of the year, we will probably try and finally see some possibility of rate cuts emerging. And if the labor market was something which was coming in the way over and above inflation, which had kind of settled down, then I would like to think that there's a positive development. It may probably finally, move the Fed out of its long, pause. And, we can then finally look forward to those rate cuts, which have been eluding us for some time. So it's still not entirely clear as to what is the extent of the slowdown as yet. There is an anticipation of the market as reflected from the 10-year out there that the slowdown is very significant, but may not necessarily be the case. We've seen very sharp decline in the treasury yields out there, as we know. So we'll wait and watch. But I think at some level, it is not entirely doomsday, I would think, as far as the US is concerned.
Tahir, hi. Good morning. Let's talk about India. By the way, I was checking. NASDAQ futures are again down almost 500 points. So the fear factor is really working its way through the futures market, at least the traders that are active right now. Even Dow futures are down about 300. So let's see when we see the end of it. Tahir, morning. So the thing is, Prashant was talking about one-way moves, right? And the narrative that has been drilled into investors here in India is that you must buy every dip, and they've been following that to the T, right? It's a one-way market. Every dip is bought in. Investors only know that they need to pump in money whenever the market falls, which is fine. No one seems to be talking about profit-taking. No one seems to be talking about the other end of the spectrum. Your thoughts here, given the elevated levels of the market, the fantastic rally that we've had, is profit booking advised in any parts of the market?
So we have been taking this view that since a fairly long period of time, while we did in the last conversation mentioned that we've taken some heart in the earnings delivery up until now, and generally corporate earnings in India still being reasonably stable. But obviously we are expecting a fair bit of volatility in the second half, driven by many events. Some of these events which have happened in the last few days are not necessarily what we entirely anticipated, but we were expecting that there would be possibility of volatility coming through in the second half of the year, and that may crimp returns compared to what we have been used to in the past. So yes, you're right that we do not necessarily expect the second half to be as smooth as what the market behavior has been, especially in India in the last 6 to 9 months' time. And I think some of the other events are yet pending, whether it be in the form of outcome of US elections, as well as in terms of the direction of interest rates. But I think there are, from the events of what has happened in the last some days, there's some positives as well. So we like as I said, that we do now see a possibility of interest rates both in the US as well as following through in India, cut in interest rates coming through. And the second being that, fortunately, despite the fact that there's a war-like background once again in the Middle East, we've seen commodity prices, particularly oil, behave reasonably well, in fact, favorably. So again, a departure from what we typically see when there is geopolitical risks. But this is something which probably will come to India's defense. But in the meanwhile, yes, we'll see volatility. We'll probably see churn in the market. We'll see rotation as well for whatever duration of time from, let's say, certain aggressives to certain defensives. So all that is what we probably expect and to unfold in the next up until the end of this calendar year. And to some extent, we've tried to prepare ourselves in terms of our portfolio positionings to, defend ourselves.
You mentioned rate cuts. Just to complete that point, in the US and in India, you're expecting, I mean, how much of a rate cut in India in this calendar year?
So, well, we've not put a number to it, but essentially, I wouldn't be surprised that we start off with at least a 20, 25 basis points, and probably in the next 6 months' time, we get to a 50 odd basis points if the US particularly commences on its rate cycle.
Hi, Tahir. Good morning. So it appears the risks are global in nature. U.S. recession, the reversal of the yen carry trade, as well as geopolitical issues, they're back on the table. And given that sort of environment, which is the place to hide here in the Indian markets? The FMCG stocks, for the time being at least, they're doing relatively better. The Nifty is down 500 points. You have green on HUL, Britannia, Marico. They're doing pretty well. What's your view on the FMCG pack?
So once again, Nigel, we spoke about that as well some conversations ago, and exactly that there will be some of these sectors which will probably make a comeback for one reason or the other, and there is a confluence of factors which have started to fall in line, stars aligning, so to speak. One is that we've got a good monsoon. We've already had a fair bit of deep cyclicality as far as the sector is concerned. Many parts of the FMCG stroke, consumer durables stroke, value retail, if I were to call it, or consumption at the lower end of the market in general. Those are parts which have actually lagged the overall market in the last almost 24 odd months. So clearly a catch up. There are certain factors, interest rates coming along the way. That has also been a factor which affects these pockets of the market a little more than what it does to the others. So the reversal of interest rates probably should also kind of act as a support. So I think. And last but not the least, I think obviously the market is not significantly exposed out there in terms of ownership levels, at least incremental ownership in the recent past. So I think these all should drive up valuations out there. Certain expectations will develop out there. Maybe they will overshoot as well in the short run. So that's kind of likely. And that's like where I said that, sector rotation away from certain risk assets, away from probably parts of value to growth parts of the market is quite likely.
Just coming back to you, Tahir, I want to highlight a few more names as we are moving on, as we're seeing. Just a few sort of stocks, really. You've got Senco, will come up on your screen. That's up 1%. There is, of course, all these FMCG stocks are higher. Marico, HUL, Sun Pharma is high. UPL still trades in the green. There is Lux Industries out of the blue. Coming up as one of the top traded names, but it's up 1.5% at this point in time. Kernex is flattish. Samhi is up about 1.33%. So it's a mix, but market breadth is of course overwhelmingly lower at this point in time. I think some 20 stocks lower as compared to 20 to 1 in favor of declines at this point in time. Lots of 5-6% cuts. The railway stocks are all down. Mazgaon is down 6% or so. There is NBCC, which is down 7%. IFCI, Ircon, Railtel. These are all names which are down between 5, 6, 7%. And of course, so much more. So 500 points down now. We're at about 24,200. Now 24,200 is to my mind a decent kind of support level. Market spent a fair bit of time around these levels. So let's see if we are able to hold this. Otherwise, you're essentially then looking at the lows of the day in the budget, which is about 24,074 or so, 24,100 roughly. But we'll see if the 24,200 comes into play, and then by close we are able to hold on to it or not. Tahir, what else would you do at this point in time, and what would you ask your team to focus on at this stage?
So, we've not really changed any major tack in terms of our approach to the markets. We continue to ideate. We continue to look at various parts of the market. In some of the value parts which have done exceedingly well as well. Some of these corrections are welcome. probably they will give us some better entry points. Look, like as I said, I mean, we do expect that the markets will moderate. There will be certain, return expectations that we need to recalibrate. We need to be somewhat more conscious about risk over return. All that said, I mean, we don't expect very deep corrections or deep cuts in the market because we generally believe that when we look at the overall economic scenario and the health, it's not something which is very daunting. There will be some of these global circumstances which will create disturbances once in a while. But I think if we are not expecting deep corrections in the first place, so if we get something which is of that 5-7% variety, which is what it should turn out to be in my view, I think in that process, if we get certain interesting opportunities across a swath of sectors, we are prepared for it. But in the meanwhile, need to be more balanced in terms of the overall portfolio configuration, at least to make sure that we don't get we prepare for risks more than return. And I think to that extent, rebalancing the portfolio has been undertaken in the recent past. We'll try and continue to explore those possibilities, whether it be sectors like FMCG or consumption, lower end consumption, maybe IT also to some extent. Perhaps banks, they too might become interesting at some stage. So I think this is how we will probably approach it. Bottom line is basically just try and keep as much diversity as possible, positive framework, but use corrections as opportunities to buy what you would have loved to buy at better price points.
Okay. All right. Tahir, thank you very much for all the perspective. Much appreciated. You have a good day, and we look forward to the next call.